Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
I want to bring in somebody who has quite a bit of experience with the Federal Reserve, former director of the National Economic Council, former vice chair of the Federal Reserve, distinguished fellow at the Georgetown Soros Center for Financial Markets and Policy. Lael Brainerd is with us right now. It's good to have you with us this afternoon, and that's exactly where I want to start. We spoke to Mike McKee out in Victor, Idaho, and he said there was a collective eye roll when he saw the news earlier this morning from the other members of the Federal Reserve and Fed watchers out there. Do you look at the news that we got this morning, the comments from the president that we got this morning, as being different than other criticism of Jay Powell in the past?
I think there's a lot of continuity. He has clearly been very frustrated for some period of time with the Federal Reserve and their wait-and-see mode while they wait to see how tariffs are going to affect inflation and the economy. And, you know, he's very impatient to see rates come down. So I saw those comments today as being certainly in that same spirit, although, of course, the rumors early in the day had more urgency to them. Of course, subsequent to that, he seems to have pulled back those comments, and that's a good thing. I think it would be extremely bad for the United States to have a big rupture in the institutional independence of the Federal Reserve, which is what that would amount to.
Exactly. So how do you think this will affect the Fed's credibility in controlling inflation? And more broadly, how will this political move really just affect inflation expectations? We saw markets react earlier. There was really a huge whiplash from the equity market to the fixed income market.
Absolutely. So if the president of the United States were to go ahead and actually make an effort to remove the chair of the Federal Reserve, that would fly in the face of decades of institutional convention that puts the Federal Reserve in an independent position to pursue the control of inflation as well as keeping labor markets strong. And I think it would really raise important questions in the minds of investors in the United States and around the world as to whether the institutional environment that really underpins the value of Treasury securities, the strength of the dollar, and the expectation that inflation will remain low and stable in the United States, all of those things, I think, would be thrown into question. And that should lead investors to demand more to hold long-term Treasury. So that should lead to the long end of the curve going up.
Whenever the Fed chair gives a press conference, he's asked by journalists about the criticism that the president has made or is making about him. You've worked with Jay Powell for years. You know him. In your view, how does he feel about being this punching bag?
So I don't know how he feels personally, but I know that anybody in that position would feel that they have an important institutional responsibility, that he was confirmed by the U.S. Senate, that there is a legal set of expectations regarding the Federal Reserve Chair's role. And of course, monetary policy is set by a committee. It's not set by the chair alone. And so it is the Federal Open Markets Committee that has continue to hold on rates. So it's a much broader institutional environment, and personalizing it by this relentless focus on the chair, I think, is extremely problematic. Again, bad for the United States, and ultimately defeats the purpose that I think the president is trying to achieve, which is to see rates go down sustainably in an environment of growth and low inflation.
When you look at the history of political pressure exerted upon the Fed, how do you make sense of today? I'm thinking Nixon, Arthur Burns, is today worse? Is today different? Or are they more or less the same?
So I think that the past episodes where we've seen a lot of pressure on the Federal Reserve chair to lower interest rates for political reasons have ended extremely badly. And we've seen in those episodes high inflation, and the Fed has really struggled to bring inflation back down. So I think this is a kind of similar set of pressures to what some Fed chairs have felt in the past, but not in the recent past. I think in the, during the period that we have seen low and stable, what they call the great moderation, low and stable inflation, there has been a real understanding that the president, the administration should allow the Federal Reserve to conduct monetary policy in a way that establishes their credibility on inflation control. So this is a big change relative to the last 3 decades, and it's highly problematic. The president has said very explicitly that he wants to see the Federal Reserve lower rates because every percentage point that rates come down, this is what he says, it will save him $300 billion in interest payments on the national debt. And of course, that's more important than ever now that we've just added through the mega law another $4 trillion to the national debt. And so when you hear the president talking about this, he really seems to be very focused on those interest payments. And that is exactly the kind of institutional environment that would undermine the credibility of the Federal Reserve in fighting inflation and could actually lead investors to demand higher interest rates on long-term treasuries.
That's the great irony in this whole situation here. We have 20 seconds left. I just want you to make a prediction. Do you think Fed Chair Jay Powell will fulfill his term as the chairman of the Federal Reserve until May of next year?
I certainly hope so. And yes, I do.
All right. Lael Brainerd, thank you so much for joining us on Bloomberg Businessweek Daily. That is, of course, Lael Brainerd, former National Economic Council Director, former Vice Chair of the Federal Reserve, Distinguished Fellow at the Georgetown Soros Center for Financial Markets and Policy.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, the second batch of big banks reported earnings today. There was a theme: market volatility sparked by the trade war leading to record quarters for traders. Goldman stock traders posted the largest revenue haul in Wall Street history. Morgan Stanley stock traders scored their best second quarter on record. And Bank of America traders also posted a record second quarter. Watching all of this closely, Ken Leon, Director of Equity Research at CFRA Research. He joins us from Florida. So record quarters for trading across the board today, yet the stock reaction to the downside. Why is that?
Well, it's great to be here. And when you look at the global U.S. banks, they performed very strongly. What we did see was not only trading, but the elevated markets means that fee income across many different businesses like asset management, wealth management, other services generated substantial year-over-year growth. What we are also seeing is how the capital markets can be the delta for getting stronger growth, and also higher estimates expected from the street looking ahead, both for revenue and earnings. Those that are more balanced or exposed to Main Street America, consumer and small business, are likely to see much slower growth and some risk of kind of sluggish demand in the future. I think that's really the difference between the outsized significant performance of Goldman Sachs, strong growth for Morgan Stanley, and then those that were kind of in between were the JP Morgans and then Bank of America, which didn't fire on all cylinders. That's the difference.
But Ken, still, I mean, when zooming out from just today's action, even though, I mean, Goldman only being up 0.5% after posting a record quarter when it comes to trading, What is the driver of these financial shares? Is it the yield curve? Is it actually the numbers that we get in the earnings report? Is it something else? Because I feel like I go through this puzzle at least 4 times a year when we get these earnings.
Yeah, lucky for you, 4 times. For me, it's every day. And we've been overweighted the financial sector really since last November. And the large banks are, in the top 10 of that sector. And what we've seen even in the second quarter or year to date is tremendous performance, more than 2 times the S&P 500 for diversified banks. But that's not the point. The key point is, where do they go from here? We think the delta, not only for the rest of this year, but really these stocks are going to be priced on 2026 earnings, is going to be how they do into next year. Obviously, 2 to 4 rate cuts, some easing on the regulatory framework, and then also some opening up in the capital markets for investment banking. That's going to help these banks. When you look at them, in terms of PE multiples, or what Gina was talking about, the overall market, they have to earn into these valuations or multiples. When we look at more conservative metrics, which a lot of bank analysts look at, because they're a conservative lot, such as price to net tangible book value, they're pretty expensive. But I think it's earnings growth and what that does in terms of confidence that they can still have upside over the next year or two. That's the key.
Ken, I'd be remiss if we didn't ask you about the drama with regard to Fed Chair Jay Powell. The reports emerging early today that he would be fired by the president, and the president was seriously considering doing that. We saw a market reaction from the equity side and from the fixed income side. And then just a little later in the morning, we heard from the president, who denied that he would do that imminently. Yet there are certainly concerns about the way that the president feels about the Fed chair. We all know that. What would it mean for banks if this were to happen? Would it mean anything?
So I'm a global director, and I look at markets all over the world. And also when you look at the bond market and really the 10 and 30-year treasury, the Fed really matters. Its independence, the respect and responsibility of its 2 mandates for inflation and full employment. I just think this is color or drama. Jay Powell is highly regarded. And the other issue, of course, is when his term is up next year, likely probably to retire, but he could stay on for a few more years as a governor.
Okay, so what would happen, though, if he were forced out?
I don't see that scenario.
You really don't.
But at the end of the day,
even if they were to find some potential, look, the president has targeted the handling of the Fed renovation. What if there's something there and he can push him out through that?
So President Trump's going to get a dovish Fed chairman in part. Nobody's really hawkish today. The data will suggest possibly a slower U.S. economy rest of this year, which is why we're much more positive on the delta of the capital markets, not Main Street America, to help large banks' earnings. So we're just going to have to see. But, overall, Fed's going to be independent. And, of course, we're going to get rate cuts either way.
I have a thought as to what would happen to the banks if Jerome Powell were forced out. You would see a lot of volatility, and the banks would probably trade it, Ken. And that brings me back to all of these trading records that we saw, at least for Goldman, and then these bumper quarters that the other big banks put up. Of course, we know what happened in April. We had Liberation Day at the start of the month, and then we had the walk back. And it seems like that was a big boost for these banks. And the question that comes about is, how sustainable is that? When you think about all of this revenue that's being made in training, how sustainable is that?
It's not the trading. You really need to focus on financial sponsors, which are the large private equity firms. They're sitting on $2 trillion of companies they own, they have to monetize in some way, and also afford the investment bankers to get that job done. That's where I would really look as a delta that we haven't seen really in the numbers and size as it relates to mergers and acquisitions, equity underwriting, or other forms of transactions. look to lower rates, making it more appealing to valuation for both public and private transactions, that's going to be a bonanza for the large banks.
Ken Leon, Director of Equity Research at CFRA. Thanks so much, Ken. Good to see you this afternoon.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So, Tim, we're now halfway through the year, and a lot of uncertainties that loomed earlier haven't really gone away. Markets initially cheered the idea that, tariffs may not be severe as feared, but that optimism is starting to fade, and we're starting to see the first signs of an inflationary impact. So, for instance, this week's CPI is one example of that warning. So, bond markets are responding, longer dated yields are beginning to climb. And with us to make sense of all of those market moves is Simeon Hyman. He is global investment strategist and head of investment strategy at ProShares. That's an ETF issuer that manages some $85 billion in assets. So not really that much. I'm kidding. It's a lot. So thank you, Simeon. Before anything, we really have to start with the story of the day, and that is Jerome Powell, the fate of the Fed chair. As a strategist, how do you make sense of all of this? Are these real so-called threats, or are they just noise?
Well, thanks for having me. And what I find very interesting about this is I think that the president is making the same mistake that a lot of investors do. And what do I mean by that? The focus on the Fed funds rate. In the absence of quantitative easing, the Fed only controls the overnight lending rate. Longer-term yields are determined by market forces. We can park quantitative easing, the thing that happened in the great financial crisis and in the pandemic. But in the absence of that, what history shows is that if the Fed cuts, that usually is a steepener because it's stimulating the economy, and the long end usually sells off a little bit. So it's almost a misguided focus, because if you get what you wish for, that's not going to bring down longer term rates. They're driven primarily by inflation, which we see benign reading this morning, but still overall ticking up just a little bit, and the long end has been selling off for a couple months. So
ironically, the best way to bring rates down would be to bring inflation under control.
Correct. I mean, that's really the only way of long term is to keep them in check.
This is macroeconomics 101 that
it's
we're talking
101,
about here.
And the numbers are pretty clear.
Yeah.
The real rate on the above inflation for the 10-year Treasury historically is somewhere around 2.5%. So if we really got to 2, then you're talking 4.5, which is where we are. But if we end up sitting around 2.5, 3, that's where you can have that 5 handle.
So if the real way to bring rates down is to get inflation under control, how do you view the new tariff regime?
Well, that's the risk. And I think part of the tariff story is euphoria around the acknowledgement that it's not going to be as bad as it looked like on Liberation Day. But as you noted, the euphoria is wearing out, because if we end up with 10 or 15% across the board, that's still a lot more than the 3 we had prior to this administration. So the reality that even whatever tariffs come out will be higher than before, that's absolutely inflationary.
When you think of historical examples when it comes to political pressures on the Fed, how did markets react? I'm thinking maybe Arthur Burns or Nixon. Or maybe this time is different because, I mean, we are in 2025 and the president is different from the previous presidents. What do you make of that?
No, it's not good. I mean, that's what we had in the 70s. We had stagflation because there was a lot of political pressure on the Fed, and it took Paul Volcker to clean it up. So the market will embrace the continued independence of the Fed for sure.
And to the point of many sources, like the chair does not make unilateral decisions on interest rate. Like if President Donald Trump replaces Powell, whoever the Fed chair will be, that person's decision may be still overturned. So it's really interesting. But this is clearly a political move, some would say.
It's just back to the first principles. If someone goes in there and they ease too quickly and inflation expectations rise, longer term interest rates will go up.
Is all this a distraction in your view?
I think it's a distraction because the odds are that, as we heard, Powell's not going to be fired and the Fed will probably not be early. The odds are that, if anything, they err on being a little bit on the late side. So the status quo of the error being on the late side and having the economy get a little too deep in recession before their cuts is still the most likely scenario.
What are the legal institutional limits of a U.S. president's ability to really just remove the Fed chair? And how might this add to the ongoing uncertainty in markets? I feel like every day the list just grows longer and longer.
what we've heard over the last few months is that compared to the heads of other agencies, it appears that the Federal Reserve Chair is more protected from most presidential actions than some of the other heads of agencies that are not even with us anymore. So I think there's definitely more protections in place, but none of them are impenetrable, as we found out over the last few months in many instances.
Still, over the last few months, since the post-April 2nd bottom of at least the markets this cycle, we've seen a sustained rally higher in equities, despite the fact that I think for a lot of people would argue we don't really have certainty when it comes to tariff policy. Is the market taking the threat of tariffs going into full effect August 1st seriously right now?
There's a little bit of the euphoria that I just spoke about. In other words, since it's not as bad as the stuff from the lawn on April 2nd, there was such a relief rally, and that might have gone a little bit too far. But I think that's not the only reason that the market has rallied so strongly since roughly April 8th. And, that is the fact that fundamentals are so strong. Whether you look at the S&P 500 or the NASDAQ 100, compared to 20 years ago, return on assets stronger, profit margins stronger. Everything is there in spades. And by the way, the NASDAQ 100 was at 30 times then as well. So there is quality support there. The quality of earnings, the cash flow that is generated per dollar of earnings is much better than it was just a generation ago.
Moving forward from today's really huge whiplash of a news, what do you make of the inflation story, especially in light of the big, beautiful bill? Does the Fed have enough reason to ease?
I don't think they can ease that quickly in the face of the big, beautiful bill, because that's clearly expansionary and it adds to the deficit. And I'm not taking any sort of scary point of view here that we're going to have a real deficit problem, but mildly inflationary for sure.
And how about dollar weakness? How is this affecting your general views or your asset allocation? How much of a tailwind is it or not a tailwind?
I think the dollar weakness, combine that with the possible for a little bit of a sell-off further on the long end of the curve, those are related phenomena because both of them related to inflation pressures in the U.S. and a little bit of the growing deficit tarnishing the safe haven. So you absolutely do want some other sources of diversification. Think about it this way. If you look at bonds traditionally the offset to equity risk, but that doesn't always work. It didn't work Liberation Day. Remember, we had the de-dollarization thing and bonds sold off with stocks. And of course, the wound in everybody's psyche is from 2022. The equity market went down 20%. Long treasuries went down 30 in 2022. So we can't quite count on either bonds or the dollar for either the perfect stability or diversification. You got to look elsewhere.
Where do you look?
A couple of ideas that we think are important. First, this is a particularly strong environment for cryptocurrency. We know that the regulatory environment has improved a little bit, but we also
improved a little bit. I mean, it's like a sea change.
We're waiting, and it looks good. I don't do the political beat, but
Yeah.
the odds are something's going to happen, and it doesn't have to be perfect.
Well,
right?
markets are the crypto markets.
The crypto markets believe that, and again, the view of the leading voices there are the regulation doesn't have to be perfect. Just give us something that's reasonable. We'll know what to do.
Okay, whenever somebody is on our air and says cryptocurrency, I always get pushback online because people say Bitcoin, not all crypto is Bitcoin. Bitcoin is not all crypto. So when you say cryptocurrency as an option out there, what specifically are you talking about?
Well, you can go beyond Bitcoin, and Ether is certainly a reasonable opportunity. And then you have a couple of sister guys. You have Solana, which is more in the Ether camp, and then you have XRP as an example with the fixed supply that's more in the Bitcoin camp. So I think there's an opportunity there to be a little bit more diversified. And I think the mistake some folks make in the crypto landscape is they think that, well, it's just a risk asset, like everything. It's just going up with the equity rally. But remember 3 years ago when the crypto-related banks were Bitcoin went up.
Yeah.
It really can be a diversifier. So I think that's one place.
You don't think that it's has too short of a history to call it a diversifier? It emerged after the financial crisis. We don't have that long of a history to look at to say that.
And the fact that it changes its behavior from haven to risk assets, depending on its mood, it seems.
This is so intertwined with all the disruptions that are going on right now, and you have to, I would suggest, walk and chew gum. It's almost inseparable from AI in the sense that there's a lot of disruption going on at once. And to ignore it, I think, is at one's own peril. It doesn't mean that you dive in and hold your nose and just go to the bottom of the ocean. But think about, in the equity markets as well, think about the AI disruption. You know, way back when, in the late 90s, there was this book called The Innovator's Dilemma.
Yeah.
And it said that the thesis of The Innovator's Dilemma was that incumbent companies cannot take advantage of technological innovation because it screws up their cash cows.
Clayton Christensen of Harvard Business School, a legend who just passed away a few years ago.
I didn't even realize that. Now, today, we got a lot of incumbents who appear to be making a ton of coin off of this disruptive technology, which is entirely different than that thesis. But there are still some disruptors too. So we have this environment where I think you have to at least participate in the disruption, but still, you know, have a lot of the legacy companies and, of course, legacy diversifiers. It's not that you don't want bonds, but you don't know that they're going to diversify you. And cryptocurrency and the blockchain is a real thing that's not going anywhere.
Simeon, thanks for joining us. Come back again soon.
Thanks for having me.
Really good to see you. Simeon Hyman, Global Investment Strategist, Head of Investment Strategy at the ETF issuer ProShares, joining us here in the Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Taking a break from the coverage of the Federal Reserve and talking about rare earths because they are getting a lot of attention right now. Just today, we learned that Canada's Ucore Rare Metals aims to start producing rare earth elements at a new location, a Louisiana facility, next May. It boosts U.S. processing capacity in an industry that's currently dominated by China. For all things rare earths, we bring back Dr. Gracelyn Bascarin. She's director of the Critical Minerals Security Program at the Center for Strategic and International Studies. She joins us from the Bloomberg Toronto. She joins us from Toronto. I know you've been on a lot of planes in the last few days, so we appreciate you joining us from where in the world is Gracelyn Bascarin. I want to know, because we haven't spoken to you in a few weeks, and since then we've gotten a lot of announcements, including from MP Materials, from Apple, this latest from Canada's Ucore Rare Metals. Is the U.S. on its way to relying less on China for rare earths?
U.S. is well on its way. In the last 2 months, we've seen astronomical progress from a point that U.S. automotive manufacture came to a screeching halt, and we were virtually begging China to give us some rare earths, both in Geneva and London, to at a point now where the U.S. government is the biggest owner in an unprecedented move of the biggest rare earths company here in the United States. We have a price floor that's close to double current prices that the government has committed to paying. We're building new permanent magnet manufacturing facilities. This is really a story that when the U.S. sets its mind to something, it can do it, and it can do it quickly.
Well, on that, we spoke to James Litinsky last week of MP Materials. It's the day the company struck this multi-billion-dollar public-private deal with the U.S. Department of Defense to build this new magnet plant, expand rare earth capabilities. It's backed by $400 million in equity and a $1 billion loan commitment. Here's what he said about that deal.
The government wants to achieve an important national security objective, and we at MP are able to help them achieve that objective. And so they are going to help support us in accelerating investment in our space, and they're going to create the conditions that allow us to invest with a fair return on capital and not be attacked, so to speak, by mercantilism. And in exchange for that, they're going to expect some upside. And so again, I think this is, hopefully it's a new model that we can utilize across some of these verticals that are really challenging for us, where we've been unable to fully reshore industries because we're facing competition that is thinking differently.
That's James Litinsky of MP Materials just last week on our program. The Department of Defense, Gracelyn, is positioned to become the company's largest shareholder. What is your view on this? Is this what's needed to boost critical minerals and rare earths in the U.S.?
There's two important things to consider about this equity. The first is that it will bring in a return to the American taxpayer, and it already is. When share price is increased, that means that the U.S. taxpayer is getting a return on that investment. That's a big deal. The second thing that's important is there is no bigger signal to the private sector than having government ownership. So as the government went in for equity, we saw companies like JP Morgan and Goldman Sachs also come to the table with a significant amount of capital. Because where there is a project challenge or a hiccup, it's more likely to get resolved when it's part owned by the government. So this is a really powerful step in terms of mobilizing private capital, but also in terms of creating a more financially sustainable model that will yield a return, both in terms of actual security of minerals and magnets, but also a return on the investment.
So we know that Apple made a strategic commitment to MP, and we also know that the Department of Defense also did the same. How does those two alter the geopolitical landscape of rare earth supply chains, and will it prompt other countries or other tech defense players to follow suit?
Apple's move to invest into MP really signifies how executives are relooking at the supply chain. There was a time not too long ago where we thought about minerals, we thought about processing, and then manufacturing. But now we're starting to look at it as a vertically integrated mine to manufactured goods supply chain, because a disruption at any point in that supply chain stops it. Now, for a company like Apple, this is really important. When we started talking about tariffs, the beginning of the year, and two, potential, rare earth disruptions, we started looking at what the cost of an iPhone could increase to. An iPhone is an incredibly price-sensitive good. The average American consumer can't easily go from paying $1,000 a phone to $1,400 a phone if those rare earths become more expensive or more difficult to access. So for a company like Apple, ensuring that there is that reliability of supply is really critical. It also makes sure that it is an American supply chain, which is really important for this administration.
Gracelyn Baskrin, thanks for taking the time. Know you've been running from airport to office, so really appreciate you joining us. Director of Critical Mineral Security at the Strategic and International Studies.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.